Mike, Ryan, I want to thank you guys for taking the time today to go through really I guess, information about the third quarter of 2018, which was kind of an interesting quarter. And then we can sort of maybe touch on some of the recent market events as well, just to sort of get a full update on where things are at. But there was, a lot of great things happened, a lot of interesting things happened. And so, yeah, let's dive right into it. I'll pass it over to you guys and ask questions along the way.
Great. Yeah, thanks a lot, Scott. It's always great when you have us come out after a bumpy month like October. Clients tend to want to hear from us during the volatile times, and everybody seems to be asking us, is this the start of worse things to come, like a bear market, a recession? And we're not actually in that camp, but we're happy to kind of share our current views and what we're planning to do about it. But I thought we'd start with a bit of a review on where things sit right now, and taking a look at the recent past performance, and then we'll talk about where things are headed. Before I move into things, I just want to draw attention to the disclaimer on the front page. I mean, Ryan and I sometimes will share some views that are kind of more strongly our own, as opposed to that of Connor Clark and Lund Private Capital. So just want to make that point. But we'll be covering, like I said, performance highlights, economic factors driving the markets, investment market themes, and our outlook moving forward. And most importantly, what are we doing about it? What's our portfolio positioning? What do we think? Where do we think is the best place for people's money moving forward? For now, I'm going to kick it over to Ryan, and he can kind of cover what's been happening in quarter three and year to date.
Yeah, thanks, Mike. Thanks, Scott. So we'll spend a few minutes talking about the third quarter. The last 3 months ended September 30th, as well as the first 9 months of the year, before Mike takes it from there. So what you're seeing here on your screen in purple are the rates of return for the last 3 months or for Q3, and you'll see by far U.S. equities performing strongest, just shy of the 6% mark. And as you look under those purple numbers, you'll see gray year-to-date numbers, and we'll spend some time talking about those and reviewing those in a moment as well. So really leading the charge, U.S. equities on the back of a strong U.S. economy, and you'll see to a wide margin underperformance in international stocks, Canadian stocks, as well as the Canadian bond market being the laggard. A very different story for the first 9 months of 2018 over 2017, where the story for much of last year was global synchronized growth, where we saw the global market geographies across the globe being strong, economic as well as market-wide, and a mixed bag this year with different economies across the world, different markets behaving and performing in different ways as well. It's also on the back of rising interest rates, and we've seen for the good part of this year, especially here in North America, whether that be the Federal Reserve in the U.S. or the Bank of Canada, increasing those rates, and that certainly played into the market a little bit as well as expectations on what that looks like going forward, which Mike will spend a few minutes on. And we've also seen some recent progress on trade, notably in North America. The updated NAFTA, or our new U.S.-Mexico-Canada agreement, seems to have worked itself out, but we still have the steel and aluminum tariffs, with looks to be in line, at least for the short term. And now our focus on trade really shifts to the U.S. and China. But nevertheless, a strong quarter for U.S. stocks. As we look to the map, and again, these are local, based on local currencies, and you'll see a small difference in that U.S. number. So in U.S. dollar terms, the U.S. market was actually up about 7%. Canada slightly negative. We just saw that at -1. We look to Europe, a relatively mixed bag. A lot of noise coming out of Brexit. Germany flat for the quarter, but has been down for the year. We'll see that in a moment. France, positive territory. We look further out east, and you'll see China down slightly for the last 3 months, as well as Hong Kong, but certainly strength in Japan and positive number in South Korea as well. And take a moment here, because the numbers look a little trouble when we get to the year-to-date numbers. In terms of drivers of our performance, Canadian stocks, as you've just seen, have been the laggard, especially when it comes to their relative performance over global equities. Global large caps on the quarter didn't perform as well, or actually they performed well, but in relation to their benchmark, slightly below by about 0.1 or 0.2%. We'll see that in a moment. But in terms of adding a great deal of value, global small caps and our global small cap portfolio outperforming that benchmark by over 2%. And certainly asset mix has continued to help as we've had less capital invested in the Canadian market and more capital invested outside of Canada in that US and international market. And we'll certainly look at that more. So when you look at a rundown of the Q3 performance, what you're looking at here in those purple lines represent the underlying index, and the goldish greenish lines really representing the pools or many of the tools we use to build client portfolios, and the far margin, the year-to-date numbers, just so you can compare. On the bond side, the core Canadian bond universe down by about 1% over the last 3 months, and us adding value in both our core as well as short-term and high-yield portfolios. And when you take those three in combination as we manage interest rate sensitivity and interest rate risk, certainly adding a great deal of value above that benchmark. Moving on to Canadian stocks, you'll see that purple number there again, minus 0.6% for the index. A lot of strength in concentrated around dividend growth, and you'll see that portfolio at just shy of the 1% mark. And then some weakness on the core portfolio, down about 1.4%. Canadian value essentially flat for the year. We'll talk about that more in the year-to-date return, but that's been a sector or an asset class style that's been out of favor in the recent past. And small caps as well, underperforming the broader TSX. But certainly a part of our small cap 2 portfolio, which you'll see next. So a quick note, that small cap 2 portfolio, a bit of a hybrid. It includes not only Canadian small caps, but global small caps as well. And that's highlighted under the global equity section, where you'll see global alpha small cap. And that portfolio makes up right now about 80% global and 20% Canadian small cap, and certainly providing a great deal of value. So in line with global equities, we'll see positive number there for the world at 3.4%. Again, some really good outperformance where income and dividend growth is concerned, and relatively in line in our core portfolio at 3.2%, followed by our small caps at 2.4%. And when you break that down further to the S&P 500 or the international market, the EFI, again, there's that 5.8 we saw. Again, dividend growers showing a lot of value there in our portfolio, and our core U.S. equity market in line at 5.3. International market detracting somewhat off the quarter, negative 0.3, with our international portfolio adding a lot of value at positive 0.4. And then we'll go on to alternatives, and the multi-strategy there reported to the end of September, in line with the bond and the core bond universe. And that's a position right now where we've sourced from that Canadian bond portion of the portfolio for some clients. And our expectation there is the potential or the risk-adjusted potential going forward is that much more within that portfolio than the interest rate sensitivity we see on the bond side. And then we'll talk about alternatives later on in the discussion, but these numbers represent the second quarter, and the year-to-date numbers in the market represent the first half of the year, the first 6 months, and those portfolios performing well on the quarter as well as the year-to-date, and certainly adding a lot of value to client portfolios where they're held. So when we move on to the year, not a drastically different story. U.S. stocks certainly outperforming there above the 14% mark, so that number amplified from Q3. And the difference here is international Canadian markets for the first 9 months continue to be positive. International at about 2.2%. Canadian stocks there you see just above the 1% number. And over Q3, Canadian bonds were pulled down to negative territory. Much of the same concerns or the same asterisks there, whether it be U.S. strength and a strong U.S. economy, divergence in global growth, as well as increasing rates and some trade concerns globally.
Yeah, we should make a point here that those are numbers as of the end of September. If you look at numbers as of a few days ago in November, Canadian stocks and national stocks are down about 3 to 4% on the year, and U.S. stocks are still the only U.S. stocks are the only thing that's up, and U.S. stocks are up about 9.6%, so about 5% off of where we were as of the end of September, because there was that 10+% correction in October, which was quite bumpy. and even stocks, even bonds for the year are actually down over 1% now for the year. So kind of a tough market when you're not making any money in Canadian stocks, international stocks, or bonds. The only place you could make money is in U.S. stocks this year and alternative investments.
Thanks, Mike. And that same is true here when we look to the map. These are returns that are as at the end of September. And a very similar story to the Q3 map we looked at. The most notable difference here, you may notice, is China. On the year to the end of September, China down at about 15%. And China makes up about half of the emerging market index. And that's where we've seen a lot of weakness in the international market as well. But certainly in U.S. dollar terms, U.S. up 9% again to the end of September. Canada down slightly, and a similar story in Europe, with Germany down 8% on the year as they were flat for the third quarter.
And trade wars is obviously a big factor in Canada. That's been resolved, but the trade wars between U.S. and China continue to go on, and so that's one of the things that's impacting China is the uncertainty around that.
So if we look to really what's driven some of those returns for the first 9 months of the year, again, asset mix has played a big role, and part of that is owning less Canadian stock and more global stock, as that's outperformed. Certainly on the U.S. side, and Canadian value, again, has been a style that's been out of favor for some time and been a small detractor. Again, relatively underweight given our underweight positioning in Canadian stocks on the year as well. So if we look to the first 9 months of the year, and again to the end of September, a similar story, a few different numbers here, but bonds down 0.4% on the year for the first 9 months. Outperformance across both short-term core and high-yield bonds. Looking to Canadian stocks, again, a focus or outperformance there on dividend growers, and that is to a big extent a Canadian attribute. Our core portfolio also coming in line, slightly exceeding the benchmark TSX, and then you'll see value there essentially flat on the year at 0.2%. As you look to the global market, you'll see the MSCI World, or the global index, at about 9.5%, and you'll see outperformance for our core global equity portfolio, and good absolute numbers coming out of our dividend-focused income and growth portfolio at 9%, but slightly behind the overall benchmark. You'll see that small cap 2 portfolio I spoke about earlier coming in ahead of the global portfolios. And again, that is a significant portion, 80% of that small cap 2 portfolio you'll see about in the middle line of that page. And if you break it down further between the U.S. and international, again, a good absolute number coming out of the U.S. at 14%. Our portfolios exceeding that S&P 500, which are our solid returns and certainly adding some good value for client portfolios as well. And then on the international side, the EFI coming in 2.2%, our portfolio essentially doubling that for the first 9 months of the year at the 5% mark. And you'll see, again, to the end of September, multi-strategy at 0.5, that's reported, as well as the other alternatives based on Q3 returns. And you'll see, again, portions of that multi-strategy source from bond component of client portfolios.
And so I'll cover off some of the economic factors driving the markets right now. And, I think that's one of the biggest wild cards is October the sign of more negative things to come, or is it just a correction, which is actually healthy in the marketplace, taking one step back so we can take 2 steps forward again? And we're more in the camp that it was a correction and probably a buying opportunity in the later parts of October. And probably, things are still down for the year. So probably now our view is that it's more of a nice buying opportunity. But one of the things that we're certainly considering here is that we're 9 years into this bull market. We've had, this is the second longest economic expansion in history. The biggest would have been during the tech bubble days through the 90s, coming out of that recession right into 2000. But if you look at average real GDP growth over that time frame, we're still well below where it's been in the past. So there's still probably a little bit of room for this to run for another 2+ years before we see any kind of recession. But we need to watch things like interest rates going up. If it goes up too quickly, too much, that could be probably one of the biggest drivers that could get us back into a recessionary time frame. And debt levels around the world are quite high, in particular in Canada. So, Ryan's already mentioned that growth has been divergent across the different economies, and this chart's kind of an interesting one. It shows a lot. The purple is where we are now in 2018. The arrow is showing where we're headed directionally. Financial conditions: are we tightening? Are we loosening? Are interest rates going up or down? And so the arrow is pointing to the left. It means that interest rates are going down. Where it's going another direction, interest rates are going up. So most economies are starting to raise rates, but China and Japan is still being quite accommodative in lowering rates. And then if the arrow is pointing down, it means real GDP growth is slowing. Doesn't mean it's we're going negative, but we're growing at a slowing pace. And where the arrow is going up, GDP is improving and getting better. So only the Eurozone is improving. The rest of the world, we're looking at GDP slowing, which is not a bad thing, but it just means maybe less good. So instead of stocks market returns being 10+%, 5 to 7 might be the new normal. I covered off a lot of these things about economic growth and monetary policy. Most economies are growing at a slowing pace. Some economies are growing at an accelerating pace, and the U.S. has a lot of very positive things going on, so momentum is kind of best in the U.S. right now. Interest rates are generally going up in most parts of the world, but some parts of the world are still being accommodative. And if interest rates are going up, that's going to put some pressure on bonds and stocks. So trade wars, everybody was kind of interested in hearing from us on that. The chart below here kind of shows you the trade tariff announcements, and the first thing that got announced back in January was washing machines and solar panels. Shortly after that was steel and aluminum, and then you can see when trade tariffs in China got announced, and some of the retaliatory tariffs from Mexico. So that's why it's called trade wars, back and forth battles and discussions. Still very much ongoing in China, but Canada and Mexico have resolved things with the U.S., which is nice. But here you can see how trade tariffs ultimately will hit the consumer wallet. And you can see year-over-year change of laundry equipment like washing machines, how stable it's been and how it's spiked following these trade wars. So higher tariffs just mean higher prices for consumers. And if we had less money in our pocket, we had less money to spend, less money to invest, and that's generally not good for the economy. So it's something we do need to keep track of. Immediately, as soon as the tariffs got announced, there was an impact on the U.S. Real GDP in 2018. The planned impact for 2019 is about 0.3, 0.4%. And 2020, there's going to be a lingering impact about 0.1 to 0.2% impact. So nothing crazy, but it is something we got to factor in. It's going to be a little bit less good. Trade as a percentage of GDP is very high in places like Mexico and Canada, which is why it was so important for us to get things resolved with the U.S. A bit of a wild card for us in Canada. With China, it's only 37%. So even though the trade wars are still going on, it's not going to be nearly as significant in China. But we do need to consider how that's going to impact China moving forward. Interest rates are going up, no surprises there. The purple line is showing you the year-end estimates in terms of where rates could be headed. And I think it's generally understood and accepted that the U.S. is going to raise rates another 2 or 3 times from here, Canada as well, over the next year. So we just got to be ready for rising rates. And wherever we can, we got to manage around that interest rate risk for clients. Unemployment is at a very low point right now. Earnings have been moving up a fair bit, so we've got a very strong labor market right now. The energy sector has been a little bit volatile. Actually, at the end of September, oil was close to $80. Now it's back down in the 50s. So we've seen a fair bit of decline in the price of oil. Trump has stated that he wants to have cheap oil. So somehow he seems to be getting his way on some of these things. So what are some of the investment market themes and outlook? In general, when you look at the markets, it's been very positive up until October. We did have a correction, a 10+% sell-off in January, another one in March, related to interest rates going up and trade wars. October got very bumpy because of more of the same, fear about interest rates going up, trade wars. A couple companies came out with negative earnings right out of the gate at the beginning of October, and that sent the market down in a bit of an emotional spiral. Again, taking a look at where we are in the recovery, you can see the growth of $1 between 2009 and the present time. We've had a really good expansion phase here. The 1990 to 2000 timeframe has outperformed that and lasted a little bit longer. So we still got maybe a little bit of room where we can get some more growth of the market before we expect a recession. And, we're not just looking at market sentiment and these kind of things. There's a lot of factors that we look at when we track whether or not we're headed towards a recession. And if there was check marks right across the page here, then our certainty of a recession is quite high. But we've only got 3 things that are kind of looking like we've got higher risk for a recession, and many that aren't happening. So we still think there's some time. We're in the later stage of the business cycle, 7th inning stretch, even into the 8th inning, but there's still a little bit of ball game left. Earnings growth has been strong, but it is expected to decline. You can see right across the board, U.S. earnings growth at 12.5, TSX at 13, MSCI World at 8, emerging markets at 12.6. That's very strong. But we expect it to be a little bit less good moving forward. Emerging markets have really been a driver of the economy in the past, but recently you can see that they've been getting hit very hard. Global equities have been generally up, driven by the U.S. Emerging markets have been quite volatile to the downside, and some of the major factors there, the U.S. dollar strengthening is not good for the emerging markets like China. They hold a lot of U.S. dollar debt, and when the U.S. dollar goes up, that means they owe more in local currency terms. Interest rates going up means that their cost of capital is going up as well, so it's a double whammy. And then they got the trade wars going on. So these are some things that are concerning us about the emerging markets right now. But generally over the next 10+ years, we'd say emerging markets will bounce back more than other parts of the world. Long term, we still favor the emerging markets, but short term, we do have some concerns. Our fixed income strategy still remains very cautious, I'd say. With interest rates going up, every time interest rates go up, core bonds start to look a little bit better. If we see some volatility in the stock market, we're also going to be a little bit shy on high yield bonds. So we've really lowered our weighting into the high yield side, and the spread is really narrowed between higher yielding corporate bonds and government bonds. So there's less upside opportunity. So we're underweight the high yield bonds right now and favoring short-term bonds, given that interest rates are likely to head up. Everybody was asked about the exchange rate, a bit of a wild card, but we're kind of in that 75-cent to 80-cent range. Now a little bit closer to the 75-cent range, but it's bobbing up and down. It's been quite tight within that range. We'd say on average, fair value for Canada has been at 84 cents. So we're still underweight, I guess, or in the more undervalued phase. And if you're looking for a prediction as to what we think moving forward, there's more factors that would favor the U.S. dollar strengthening, given the strength of the U.S. economy. And even when things get jittery in the market, it still is kind of the world's reserve currency. People flock to safety in that kind of environment, and that means more favoring the U.S. dollar. So I'll turn things over to Ryan now to talk about portfolio positioning. We covered a lot of ground on the markets. Bottom line is we don't think a recession's coming. We think it was a correction, probably a buying opportunity for clients. We generally feel that stocks might do 5 to 7 and bonds might do 1 to 3. So what does that mean for clients in terms of how we're positioning things?
Yeah, so when we looked at that positioning on the next 2 slides, we'll see, and this is a slide where you may have seen before, where we lay out each of the asset classes and each of the tools in our toolbox, and we essentially rank them in terms of what we like at a given time versus what we may not like or be not too keen on. At the top there, you'll see equities, and it speaks to our asset mix positioning, where we have more capital invested outside of Canada than within Canada. and that's really us favoring the global market over the Canadian market, and to a smaller extent, global small caps as well. As we look to bonds, our core bond outlook has shifted a little bit more of neutral now versus we were less keen on core bonds in the past. And that's really as interest rates increase, yields and rates on these bonds also increase, but it also makes these bonds cheaper from a pricing level, given the opposite relationship between rising rates and negative prices. Short-term bonds provide a good hedge around that short-term risk around interest rates. And we've also, in the summer, we also took a little bit of capital away from high yield bonds, and that really shifts to where we see that market. And in the high yield bond market, although it does have a higher yielding in periods of volatility, can trade and feel more like an equity holding than a core bond holding. So that's been taken down a little bit. Cash, of course, at the end of the day, we're still at historically low rates. So cash below at least inflation, certainly not keen on holding cash. And the alternatives as well, whether that be private debt, our market neutral hedge strategies, or infrastructure real estate, all things that we believe continue to insulate from global market volatility in the public bond and stock market, and things that if we can add, that we're certainly keen on using, again, as tools in the toolbox. If you look to the next page, you'll see similar in terms of our positioning, just shown in a very different way. Again, we show equities and fixed income and a range between our neutral in the middle and our min and our max ranges in terms of how far we feel we would lean out or lean in based on these risk-adjusted opportunities that we see. Again, generally neutral weights to equities versus fixed income, and for portfolios that own multi-strategy, again, that risk more tailored, can often feel more like bond risk. And again, that portion sourced from bond component of portfolios. And where equities are concerned, we've said it, just less cyclical and relative to Canada, and we just have more capital invested in the global market over the Canadian market. I just mentioned our underweight to high yield, as credit spreads are very tight, and credit spreads essentially have narrowed over the last little while. And our preference over short and core bonds over cash. Again, with rates at historic lows, cash doesn't provide a lot of opportunity for income or return, or even as an inflation hedge. But as we see yields increase, we certainly see the yields on these bonds increase as well. And we do a lot of work to manage the interest rate sensitivity of that. So, re-looking at the long-term asset allocation, whether that be bonds, equities, or alternatives, on the bond side, there's a lot of protection in the short term for short-term bonds, and but going longer term, as we see rates continue to rise, not much growth expected out of that portion of the portfolio. And again, our concern around rising yields. On the equity side, attractive return relative to bonds, and we believe equities will continue to outperform bonds, at least in the short term, and to a larger extent over the longer term and through many market cycles. But we do also expect a lower return than we've seen historically. That also means increasing volatility, which we've certainly seen for the months of October and so far in November as well. Our key risk, as Mike mentioned, we may be in that eighth inning of the ball game, and we certainly feel like we're at the end or closer to the end of this business cycle than we are at the beginning. And of course, we see that through the increase in volatility. And if we're able to add alternatives, again, it helps provide some insulation around that volatility or interest rate. And it certainly provides, those portfolios provide a great deal of yield. Guarantee is never a good word to use, but those contracts, whether it be a tenant, a solid commercial tenant, or a long-term project on a renewable energy facility, those are contracts and projects that we have a great deal of confidence in. The key risk there, a risk inconvenient, is more the liquidity of that on a quarterly basis. And of course, as many of us know, real estate just not easy or quickly to trade in as a bond or a stock. So if we look to some of the focuses we're taking within each component or each sector within the portfolio, Canadian equities, we're slowly reducing our cyclical exposure, buying more defensive companies and larger call quality type names. Much of that will come on the back of higher dividends, and that's just a function of that change within the underlying holdings of that portfolio. On the global equity side, similar, reducing cyclical exposure, buying higher quality companies, and overweight industries like staples and healthcare, specifically on healthcare, not so much pharma, but on the technology behind the hardware as well. On the fixed income, overweight provincial bonds, because we certainly get a pickup in the yield over provincials than federal government bonds, and owning high quality corporate bonds or investment grade bonds. And our high yield strategy, although we've taken it back a little, it's still of higher quality, as it's right at that high yield market, that BBB credit rating. And for alternatives, of course, infrastructure, looking at a more diverse range of opportunities, both renewable energy as well as traditional asset classes, private loans, real estate, which we'll also look at in a second, but very selective in terms of the loans that we make, ensuring that essentially we're getting compensated appropriately and in line with our expectations. And real estate, looking to improve on existing assets, whether that be continuing to diverse the portfolio, or slightly re-implementing or changing the function of certain assets, whether that could be something as simple as a parking lot to drive tenancy and to drive square footage rates, of course, for real estate properties. So if you look to the real estate specifically, and you look to the third quarter, 3 new properties within the portfolio, really diverse across the country. The first one there you see in Quebec, the second in British Columbia, and the third in Alberta. The third in Alberta, more of an industrial unit, and the first 2 more office commercial properties, both in Canada and British Columbia. As we look to infrastructure, and quick note, if we look to real estate for the first 6 months, again, continuing to perform in line with what we'd expect. We could always refer back, but I believe at about the 6% mark for the first half of this year. And again, that's to the end of June. We expect to see some Q3 valuations and final numbers later this month. For infrastructure, the first 2 bullets there really around the renewable energy side of the portfolio. The first, a newer renewable energy project in British Columbia, a hydro project. The second, more the same calls within the Chilean projects, which now amount to 8 different projects, and each of those coming in, at least the construction phase, coming in under budget and certainly ahead of schedule in terms of timing. And lastly, the traditional portion of the portfolio, the construction stage projects, whether that be highways in Calgary or Regina, or those in Chile that I just mentioned, again, all advancing on schedule and certainly on budget. The private loan portfolio and the healthcare IT loan that's currently held within the portfolio continues to perform well, and certainly adding yield and income, and all of that return is income as it is a loan. And also a call this week, a decent sized call at about 80 million, and a good potential to see additional calls this quarter and early into Q1 as well.
So, we've showed this chart before. I mean, I've been at the company since 2003. You can see the line spiking up after I started. So I joke with the company that I should get more credit than I do around here. But you can see how the company's continually invested in people and expanding the team in different alternative asset classes like multi-strategy, global small caps, private market investments into real estate infrastructure, more income-focused portfolios, which have been performing well in volatile times. Private loans, et cetera. But we're really invested in our future, and it's been really great to see the company grow from 400 million in assets under management to over 8 billion. The total company growing from about 10 billion to almost 80 billion now. And so we've been at it since 1982. So we've seen some ups and downs in the markets. These kind of corrections are normal. Like every 15 to 18 months, we should expect some kind of a 10+% pullback. That's normal. What's a little bit abnormal is seeing it 3 times inside of 10 months. Like I said, January, March, and again in October. That is pretty rare, which leads us to believe that it's more of a buying opportunity, and we should see things stabilize a little bit here. So probably a good time to be talking to your advisors about topping up RSPs, tax-free savings accounts. Why wait till February when the markets are up? Why not take advantage of that now, right? And for anybody that's thinking about timing out, I mean, this is just a chart we like to show. I mean, if people are in and out of the market and you miss the 10 best days, your return literally goes from 7% down to 3.8, and this is just proven looking back in time. If you miss the 20 best days, your return drops down to 1.7. If you miss the 30 best days, just 1 month, you end up with a negative return. So you got to be in it to win, especially when things are down. That's not the time to sell. You stick with your game plan, and where you can, you lean in. And this is just showing that most of the time stocks do rise, but there's going to be corrections along the way. So you can see when the markets have gone up, when the markets have gone down. The orange dots that you see are the maximum drawdown. So, at one point in the year, the stock market has dipped a whole lot more than where it ends up. But it just shows you that when things go down, they do recover and they bounce back up. So usually it becomes a buying opportunity at that point in time. Another kind of positive uplifting chart. I mean, bear markets and recessions are in the orange, and you can see that they can be down 10 to 20% on a blended balanced portfolio. 2008 to 2009, even over 20%. But you can see how long the bull markets last and what kind of gains you can make. So trying to bet on trying to time out to avoid the short-term downturns, very challenging to do. And then you got to decide how you're going to get back into that market. But 2/3 of the time the market wins, and you win by being in it. 1/3 of the time you lose. Those are pretty good odds, though. So if you have a long-term game plan, stick with a balanced benchmark over the long term. Let your manager make the active calls. That's the right kind of strategy to win over the long term. Ryan, maybe I'll just have you kind of close off here with a few slides on alternative investments and some of the modeling we've done, and then we'll open up to questions, Scott.
Yeah, thanks, Mike. So, I mentioned how there's certain risks we see in the market, and Mike has gone through those as well. And we've talked a little bit about some of the alternative investments, and a lot of the work we do is around that trade-off between risk and return. And what we found, and many of you have heard us say this before, but essentially, what we see is as we're looking to add asset classes or new tools to a portfolio, it's not just the fact that we can add them because we think they're good assets or good portfolios. Rather, it's how does the relationship between what we own in a portfolio today and what we may add in the future impact the results. And what you're looking at here essentially is that purple line, and you'll see that balance marker towards the middle there, really representing a balanced portfolio, normally 45% bond, 55% stock. And when we're able to add small elements of alternative investments, and more notably, investments that don't behave in the same way that typical bonds and stocks behave, it can change an experience for the portfolio. And specifically, it can decrease the risk profile and potentially increase our expected rate of return. And that's the goal. Anytime we can decrease a portfolio's risk profile, but increase the potential for added value, then that to us is an efficient portfolio, and certainly a good reason why we think some of these alternative and private investments make a lot of good sense when we're able to add them and utilize them to that degree. So if you look here in terms of that balance line and what that means, you'll see closer to the margin, you'll see expected return up the side and volatility towards the bottom. Again, that relationship between risk, volatility, the ups and downs, the ebbs and flows we see day to day, as well as the expected return. And where we see the smallest rate of return as well as the smallest risk is on the cash or the short-term bond or the core bond side, where we don't expect to take on a lot of risk, but we also don't expect a whole lot of return. And the opposite of that would be in the equity market as we move up along that curve towards the end, where you see small cap names, whether that be Canada or global, or to a lesser degree, global equities around Canadian large cap or global large cap slightly below that line. Again, a trade-off between the volatility that we see, but the expected risk. And we would expect that the more volatility one takes, the higher expectation would be around rates of return. Now you see further, if you look above that line towards the middle of the screen, where the private markets lie, whether that be private loan, infrastructure, real estate, hedge, our market neutral strategy. And above the line really meaning that you're getting paid additional value for owning those given its level of risk. And when we can add those elements to a portfolio, that's when it drives that line again up, increasing rate of return, and to the left, meaning decreasing the risk profile. And essentially, if we look at where we expect returns over the next, 20 years or so versus where we've come from, our expectations have certainly come down. 100% equity portfolio over the last 20 years has averaged about 6.4%. What we expect going forward is a little less than that. A balanced portfolio, again, of normally 55% equity, 45% bond, to come in just above that 5 mark. That doesn't include those alternative strategies, but certainly that number has potential to increase if and when we're able to add those solutions to a portfolio. And you'll see it there, whether that's, a 60-40 mandate in the middle at 5.3%, and adding essentially elements of real estate, private debt, infrastructure, and our market neutral portfolio, it shifts. We get a pickup of about 1% in terms of a rate of return, and you can see the probability of a decline greater than 20% shift from approximately 35% to 25%. You can see to a larger degree in a more growth-oriented portfolio, where normally we'd have 75% equity. Again, we get a pickup of a full 1% on the return side, but drastically reducing the volatility and the probability of a significant decline in value from just above the 60% marker to just below the 40% marker. So a huge pickup in return, but more so look at how the risk has decreased along the board, whether that's being more aggressive on the equity side or even having a more conservative portfolio, where you'll see on the left there with a balanced income portfolio, normally 65% bond, 35% equity. So in all elements, whether your risk aversion is higher or lower, there's certainly potential to add value where the private market investments are concerned.
Yeah, so I think we'll just kind of cap it off there. We've covered a lot of ground. Bottom line, obviously, we seem to be favoring global equities, and we really like alternative investments, but we still are big supporters of a diversified portfolio. Canada will certainly have its day again, and we want to maintain that diversification of the portfolio and even bonds. We're not big fans, but it is probably the best recession counterbalance. When interest rates start to drop again, bonds will be one of the better performing asset classes. So hopefully that covers everything, Scott. And we haven't really taken a lot of time to breathe and let you ask questions, but if there's any questions, let's open up the floor.
Yeah, well, I mean, basically what I'm hearing is that there's a strong move towards protection. There's a strong move toward, kind of getting into that defensive mode without, to try to get rid of volatility as much as possible without taking on any undue risk. Because one of the challenges, obviously, is that if with low interest rates or with a low interest rate or a rising interest rate environment, a lot of the fixed income assets are starting to either show signs of negative performance or just flat performance. And so people will, on their own, I guess they would naturally, tend toward attracting more of the areas that were performing. The problem is they're taking on a lot more risk. So I totally see where that position is sort of moving into more of a protection mode from an overall asset allocation. What I'm finding interesting, though, is there's inflation sort of not rearing its ugly head, although there's some upward pressure, I think, on inflation, but I think it has been kept at bay so far. And interest rates are rising. And I get a sense, and maybe you can confirm or deny or just let me know your thoughts on this, but I get a sense that interest rates, the governments are trying to get interest rates to a more normalized level. In my opinion, it would be not necessarily because that's where they should be, although, that does make a lot of sense just to let them get back to a normalized level because they have been artificially low for so long, and that has stimulated a lot of the growth and the energy in the economy. But I'm also almost getting a sense that they need to get interest rates to a higher level before inflation starts to rise, so that if interest rates, or to hold inflation back, and if there is a problem or there is some sort of setback, that they've actually got a lever that they can pull to reduce interest rates again to help stimulate the economy. So I'm getting a sense of that. What are your thoughts on that?
Yeah, so that's exactly right. I mean, they want to put a little bit of fuel in the tank, I guess, just in case it's needed down the road. So interest rates have to go up, and if tougher times hit, then we'll be able to reverse and lower interest rates to drive the economy forward. And quite frankly, when economies are growing, that's the time for interest rates to go up. And interest rates are going up right now, which is a sign the economy is strong enough to sustain it. And yet October was a big sell-off related to a couple negative earnings reports. Concerns about interest rates going up, which is actually a good sign that the economy is growing, and the trade wars. But we've actually resolved a lot of our issues there. So, interest rates going up is a healthy thing as long as it's slow and moderate. If it goes up too quick, too fast, too far, that's a big factor that we got to watch out for.
Well, especially on that note,
that's a positive sign.
Yeah, but especially because they've kept interest rates so low for so long, which has allowed so much debt to be accumulated, that the rising of interest rates simply means that people's debt, when it comes up for renewal, and if it's in a variable rate, is simply going to be more expensive. So making it rise too quickly just simply could put things into a real slowdown if they're not careful.
Yeah, true, and that's something we're watching very closely. I think generally the politicians, economists want to do the right thing. They don't want to be known for driving us into a recession. So we got to give them some credit that they're going to try to watch that. But if it does go too far and economic circumstances change, that's when we got to watch for a turn to not just slowing growth, but negative growth. And that's not something any of us want to see.
Yeah. Interesting. Well, listen, guys, thank you. That was very thorough and very, I kind of just sort of sat back and went on for the ride there and didn't want to jump in because there was so much information being delivered there. So I appreciate you taking the time to do that. And obviously anybody has any further questions, just reach out to your financial planner, and I'm sure you guys are always available if further questions are needed as well, needed answers to. So.
Great. And hopefully next time you have us back, the markets will be nicely up from where they are today, and we can celebrate a really good month instead of coming in after a bad month.
Yeah, that's right. Yeah, that's the thing. It's all unpredictable, so we can't time these presentations around that. So, anyways, Ryan, Mike, thank you so much. Again, we look forward to the next time we get together. And any questions come along the way, we'll be sure to reach out.